OpenAI just crossed $3.4 in annual revenue, but the real money in AI isn't going to OpenAI. I'm Alex Rivera, and I've spent the last 18 months watching where the actual money flows in this industry, not the hype, the real capital movements. And what I've discovered is this: while everyone's obsessed with ChatGPT, Claude Opus, and Gemini Ultra, the companies that are actually quietly printing money are the ones nobody's paying attention to. They're the infrastructure plays, the automation enablers, the back-office revolutionaries. Today, I'm breaking down the hidden opportunity in AI automation, the one that's already creating wealth for investors and founders who understand where the puck is moving. Let me start with something that blew my mind when I first saw it. In Q3 2024, according to McKinsey Research, 72% of enterprise executives, that's 72 out of every 100 Fortune 500 decision makers, said they were actively deploying generative AI in production environments. Not pilots, not tests, live revenue-impacting implementations. But here's the problem: most of those implementations are failing. Why? Because deploying Gen AI isn't like deploying traditional software. It's not like rolling out Salesforce or Microsoft Teams. You can't just plug it in and go home. There's a massive gap between having access to a large language model, GPT-4, Gemini Ultra, whatever, and actually having it work reliably within your specific business context. That gap, that's where the money is. Last year, I helped a client, a mid-cap financial services company with about $2.3 in assets under management, try to integrate Claude Opus into their compliance workflow. They spent $8M licensing the model and another $1M on integration. They got 6 months into the project and realized it wasn't generalizing to their specific use cases. Hallucinations, context confusion, regulatory risk. They ended up needing a specialized automation layer on top of the base model. That automation layer cost them another $2M in custom engineering. But here's what's important. Once it worked, it eliminated 38 full-time compliance reviewers at an average cost of $94K per person per year. That's $6M in annual savings. Payback in less than a year on the additional investment. Now multiply that scenario across every enterprise in America trying to deploy these models. That's the hidden opportunity. Let me get specific about the funding pattern I'm seeing. In the last 24 months, we've seen 3 major funding rounds in the automation and integration space. Anthropic raised $2B in Series C in May 2024, led by Google and Amazon. That's headline news. Everyone covers it. But here's what got less coverage. Zapier, the workflow automation platform, has been quietly becoming the de facto integration layer for Gen AI tools. They haven't disclosed their latest valuation, but based on the market data and their reported $40M annual recurring revenue as of mid-2023, they're being discussed in VC circles at a $5B plus valuation in recent private rounds. And then there's Make, formerly Integramat, which announced $300M in funding at a $3B valuation in 2023. They're explicitly marketing themselves as the Gen AI workflow engine. 3 data points. 1 pattern. The real capital is flowing to automation infrastructure, not to the models themselves. Why? Because the model companies, OpenAI, Anthropic, Google with Gemini, they have a different problem. They're hitting a ceiling on who can actually use their products effectively. OpenAI's $3.4B ARR sounds massive until you realize that's across millions of users. When you break it down, the enterprise licensing revenue, the big, predictable, sticky contracts, is a much smaller percentage. I've seen estimates suggesting enterprise deals represent maybe 25-30% of that revenue, so we're talking roughly $850M to $1B in enterprise revenue for a company burning through billions in compute costs. That's not a sustainable model at scale. But the automation layer, the companies helping enterprises actually deploy and integrate these models, they have a completely different unit economics. When I reviewed the numbers for a company like Zapier, here's what I saw. Customer acquisition cost, around $200-$500 per enterprise client. Customer lifetime value, $45,000-$120,000 depending on usage tier. Gross margin, 80% plus because it's software. Churn, extremely low because the integration layer becomes mission-critical infrastructure once it's embedded in a company's workflow. Compare that to the unit economics of selling access to a language model. Your CAC might be $5,000. Your LTV might be $8,000. Your margins are compressed because you're essentially reselling compute. If a customer uses less, you make less. Now, let me walk you through a specific opportunity I'm tracking right now. There's a category of companies that are building what I call industry-specific AI automation platforms. These aren't horizontal tools like Zapier. They're vertical applications built on top of large language models specifically designed for particular industry. Example, I've been watching a company. I can't name them because I'm evaluating them for a fund investment. That's built a legal contract review and generation system specifically for mid-market law firms. They've licensed Claude Opus as the underlying model, but they've built 18 months of domain-specific fine-tuning, prompt engineering, and workflow automation on top of it. Their customers, law firms with 15-100 attorneys, are seeing 60-70% reduction in contract review time, 8-12% improvement in contract accuracy compared to human-only review, $400K, $800K in annual cost savings per firm, and they're charging $2, $500-4, $500 per month per firm. Their CAC is about $8,000. Their LTV is $180,000 based on a 5-year retention average. That's a 22x LTV to CAC ratio. That's venture scale. Their churn, sub 2% annually, because once they are integrated into the firm's workflow, they're too valuable to lose. And here's what's really interesting. They're one of dozens of companies pursuing this exact same playbook across different verticals. I've identified similar plays forming in insurance claims processing, healthcare prior authorization, accounting and tax preparation, real estate due diligence, supply chain demand forecasting. Each one is taking a general purpose model, GPT-4, Claude Opus, or Gemini Ultra, and wrapping it in industry-specific automation, data connectors, compliance layers, and workflow optimization. The companies building these don't need to be venture mega round. Most of them are raising Series A and B rounds in the $15M, $50M range. From a capital perspective, they're much more accessible than betting on the next OpenAI, and from a risk perspective, they're less dependent on any single model company's success. Here's what I mean. If OpenAI's GPT-5 disappoints, that's a problem for OpenAI. It's a problem for companies purely reliant on GPT-4. But for the legal contract review company I mentioned, if GPT-5 disappoints, they can swap in Claude Opus or wait for Gemini Ultra to improve. They've built abstraction layers. Their business model survives model transitions because they own the domain expertise, the data connectors, and the user relationship. That's what I'm looking for in this space. Companies with defensible moats that aren't purely dependent on a single model provider. Now, if you're an individual investor or founder, here's how I'd think about positioning in this opportunity. Option 1. Invest in the infrastructure plays, the Zapiers, the Makes, the automation platforms that are becoming the connective tissue for the entire GenAI economy. These have lower risk because the TAM, total addressable market, is massive. Basically, every enterprise in the world needs to automate workflows. But valuations are already moving up. Option 2, build a vertical. If you have domain expertise in law, healthcare, insurance, accounting, anything with a clear industry, there's still a window to build the vertical automation play for that industry. Your competition isn't OpenAI. It's not even Zapier. It's other specialists in your vertical. And the first mover usually wins because of the switching costs and data moats they build. Option 3, this is the contrarian take. Invest in the companies solving the boring problems created by GenAI deployment. I'm talking about AI-generated data quality tools, model monitoring platforms, API gateway companies that manage costs and usage. These aren't sexy. They don't get VC headlines, but every enterprise deploying models at scale needs them. And right now, the market is fragmented and underfunded. The last pattern I'll leave you with is this. Venture capital is beginning to rotate away from pure model companies and toward application and infrastructure. That's a signal. When smart money moves, it's worth paying attention. In the last VC report I reviewed, PitchBook data from Q3 2024, the average Series A in AI infrastructure was valued at $85M pre-money. Series A in pure model companies, those rounds are getting harder to close because the returns profile is less clear. That's the hidden opportunity right there. Not the models, the automation layer that makes the models useful. I've been in this industry long enough to see these patterns repeat. The companies that build the picks and shovels during the gold rush are the ones that build